Ever wonder how entire nations get built or how giant companies fund those world-changing ideas? Well, what if I told you it often comes down to a single financial tool? It's not stocks, it's bonds. And over the next few minutes, we're going to break down exactly what they are and why they're quite literally the bedrock of our whole economy.
Okay, so let's start with a big question. When a government needs to build, say, a brand new high-speed rail network, or a company like Apple wants to fund its next big thing, they can't just walk into a bank and ask for a $1 trillion loan, right? So where does that kind of money, that kind of capital, even come from? Well, you guessed it, it comes from the instrument we're talking about today.
At its absolute core, a bond is just a fancy IOU. That's it. It's a loan. You, the investor, are lending your money to a huge entity, like the US government or a major corporation. And in return for that loan, they make you a simple promise. They'll pay you back in full down the road, and along the way, they'll pay you interest for the privilege of using your money. That's the whole deal in a nutshell.
Now, obviously, this isn't some casual IOU you'd scribble on a napkin. No, this is a formal contract with very specific terms and conditions. So to really get a grip on bonds, we've got to break down the key parts of that agreement.
First up is the face value. You'll also hear it called par value. This is basically the main price tag on the IOU. It's the original loan amount that the borrower promises to pay back when the whole deal is done. So if you buy a bond with a $1,000 face value, you're set to get that $1,000 back on a specific date. Simple as that.
So what's in it for you while you're waiting to get that face value back? Well, that's where the coupon rate comes into play. This is the interest rate the borrower pays you for the loan. You can just think of it as your reward for letting them use your cash. If a bond has, say, a 5% coupon rate on a $1,000 face value, you'll get $50 a year, usually split into 2 smaller payments.
Then, of course, every loan has to have an end date. For a bond, we call that the maturity date. This is the finish line. It's that pre-agreed day when the IOU is finally settled up. The borrower repays your original loan, that face value, in full, and the contract is officially complete.
Now, not all IOUs are created equal. Bonds really do come in a few different flavors. The most common one is the fixed-rate bond. Your interest payment, that coupon, never changes. Super predictable. Then you've got floating-rate bonds, where the interest can actually go up or down with the market. And then there are zero-coupon bonds. These are kind of weird. They don't pay any periodic interest at all. Instead, you buy them at a big discount to their face value, and your entire reward is the difference you get back when it matures.
Okay, so far it all seems pretty straightforward, right? But here's where things get really interesting. This is the most crucial concept to understand about bonds. See, after a bond is issued, its price out in the open market isn't set in stone. It can, and it does, change. And this is the twist that changes everything.
This right here is the golden rule, and the best way to think about it is like a seesaw. Bond prices move in the opposite direction of interest rates. So when market interest rates go up, the price of existing older bonds goes down. But why? Well, think about it. If a brand new bond is issued today with a juicy 5% coupon, your old bond that only pays 3% suddenly looks a lot less attractive, doesn't it? To convince someone to buy your old bond, you'd have to sell it for cheaper, at a discount.
Let's just pause on that for a second. It really all boils down to that simple idea. When new bonds start paying more, your old bond is worth less. It really is that simple. If someone can get a better deal on a shiny new bond today, why would they ever pay full price for your older, lower-paying one? They wouldn't. The market automatically adjusts the price of your bond to keep its overall return competitive.
And speaking of price, there's one more little detail you've got to know. The price you usually see quoted is called the clean price. That's just the value of the bond itself. But you have to remember that bond is earning interest every single day. So if you buy it from someone halfway between coupon payments, you have to pay them back for the interest they've already earned but haven't been paid for yet. That bit is called accrued interest. So you take the clean price, add the accrued interest, and you get the dirty price, which is what you actually pay.
So we know how these things work, but let's get practical. From an investor's point of view, how do you figure out if a particular IOU is a good bet? Well, it all comes down to balancing the potential risks with the rewards.
Look, every investment has risks, and bonds are no different. The biggest one, that seesaw we just talked about, is interest rate risk, the risk that rising rates will push the value of your bond down. Then you've got credit risk. I mean, what if the borrower just can't pay you back? It can happen. And finally, there's liquidity risk. How easily can you actually sell your bond if you need to get your cash out in a hurry?
So, how do we measure that credit risk, the risk of not getting paid back? Well, that's where credit ratings come in. Big agencies like Moody's and S&P basically give the borrowers a report card, a grade from super safe, AAA, all the way down to junk status. This grade is a really quick and easy way to see how likely it is you'll get your money back. A higher grade means lower risk, but it also usually means you get a lower interest rate. No free lunch.
Okay, so a credit rating tells us about the risk of default. But what about that interest rate risk, that seesaw effect? How do we measure that? Well, to quantify it, the pros use a metric called duration. Now, it's a bit technical, but the simplest way to think about it is as a measure of a bond's sensitivity to interest rate changes. For example, a bond with a duration of 5 means that for every 1% that interest rates rise, its price is likely to fall by about 5%. The higher the duration, the bigger the swings on that seesaw.
So after weighing all of those risks, what's the reward? What is your actual payday? It really comes in two parts. First, you get those regular, predictable coupon payments along the way. That's steady income. And second, at the very end of the line, on that maturity date, you get your original investment, the full face value, returned right back to you.
All right, we have totally gone through the nuts and bolts of what a bond is, but now let's zoom all the way out. Why are these simple IOUs so unbelievably important? Why do people say they pretty much run the world? Well, bonds are a cornerstone of modern finance for a few huge reasons. For starters, it's all about capital raising. This is how governments fund everything from infrastructure to defense, and it's how companies finance their big, innovative ideas. For regular investors, like us, they can provide portfolio stability. They're like a low-volatility anchor in a stormy stock market. And for big banks and corporations, they're a key tool for managing their own debt and funding.
So here's the bottom line. Without the bond market, our financial system as we know it just wouldn't work. It is the bedrock that provides the cash for public works and private enterprise. And for millions of people, it offers a relatively safe place to put their money to work, earning a steady, predictable income.
And that leaves us with one final thought to chew on. In a world that seems to get more complicated and uncertain by the day, there's something incredibly powerful about the simple, fundamental promise of a bond. It's just, lend me this money and I promise I'll pay you back with interest. Maybe, just maybe, in today's volatile world, that simple IOU is more important than it's ever been.